Okay, folks, here we are. Like we promised with the next video in our tutorial series. What are bonds? Bonds basically are IOUs. So when you buy a bond from a company or buy a bond from a government, you're loaning them money. So what they'll do is, say you buy like a $1,000 bond and there's a 2% interest payment on it. You'll get paid 2% of that $1,000 per year. And say say it's a 10-year bond, and at the end of the 10 years, you'll get your $10,000 or your $1,000 back. So you'll get interest payments each year, 2%, and then you'll get your $1,000 back at the end of the year, or at the end of 10 years. Okay, so why are bonds issued? So you'll have like companies, governments, and even some cities. They'll issue bonds so that they can generate money for like operating cash flow, debt, and any capital expenditure improvements like building schools, highways, and hospitals. So you're thinking, why do investors like bonds? So bonds are very, very boring, especially compared to the stock market. Bonds are consistent. You know how much you're getting paid each year, and you know what to expect back at the end of the bond terms. The reason why investors like bonds so much, especially if the stock markets are dropping, because they get a steady income, steady, predictable income from bonds. So here coming up, when stock markets around the world start dropping, a lot of investors are going to run into bonds because at least they get some return on their money. So it's a predictable return on your money, and you get your money back at the end of the terms of the bonds. So there are some risks. There are some risks for bonds. So if you get a bond from a company or government or a city and they go bankrupt, or if they default on their bonds, it's going to be very hard to get your money back that you put into the bond. So you won't get your interest payments that were agreed upon, and it's very hard to get your money back if the companies or governments or cities go bankrupt. So those are the risks of bonds. The benefits are you get steady, predictable income based off of your bond terms. At the end of the bond term, you get your money back that you put into the bond, that you pay for the bond. So that's the end of the second series, What Are Bonds? Here on our channel, only time we like bonds is if the stock market is going to fall. So if we think the stock market is going to fall, then we run into bonds. Other than that, we stay in the stock market because the stock market has a lot better gains. Coming up next, stay tuned for part 3. What are mutual funds? On our channel, we love mutual funds, and you'll see why. Stay tuned.